Hello, my name is Mike Molina, and I'm a senior loan officer with Intercap Lending. For the past 31 years, it's been my privilege to help thousands of people with their financial needs and realize the dream of homeownership. Of course, the question I get asked most often is, what's going on with rates? What are they currently? Where are they going? And so on. This is especially true when there is buzz in the news about upcoming Federal Reserve meetings and whether they will raise, leave unchanged, or lower the rates, quote unquote. There is a lot of misunderstanding about what this actually means. So in this short video today, I want to explain what that really means, the impact it has, and what really drives and moves mortgage rates, and how to best predict where they're headed. This video is broken into 5 parts, and although I recommend you watch the entire video, if you want, you can choose to skip ahead to the timestamp indicated for the various topics below. To understand that, we need to first discuss the Federal Reserve, which is the central bank of the United States. Commonly referred to as the Fed, it meets 8 times each year to discuss whether to raise, lower, or leave unchanged what is known as the Fed funds rate. The Fed funds rate is the rate that is being talked about when you hear in the news that the government, again, the Fed, has an upcoming decision about what to do with rates. Now, and this is extremely important to understand, there is no immediate connection between changes the Fed makes to the Fed funds rate and mortgage rates. I can't emphasize that enough. In fact, the Fed funds rate is not even a rate that consumers at large can borrow at on any type of loan. So that is the definition of what the Fed funds rate is. We'll talk about what its importance and what it actually does in just a little bit. But first, we need to have a short discussion about banking basics and how banks function. As everybody knows, a bank provides a place where people can safely deposit money. In return for placing their money in a bank, people are paid a nominal rate of interest on their deposits, and they allow the bank to use those deposits for loans to other consumers. When the bank lends the money to other consumers, it charges a rate of interest that is higher than what the bank is paying to its depositors. This is, of course, how banks make money. Obviously, a bank can only lend out as much money as it has on deposit, unless it borrows money itself to lend. The problem is that if a bank kept 100% of all deposits, it would not be able to lend out any money because it's keeping it all. On the other hand, if it lent out all the money it has on deposit, then it wouldn't have any cash to give to its depositors when they come calling for some or possibly all of their cash. In other words, the bank would have a liquidity problem. For that reason, banks retain a small percentage of their total deposits as quote-unquote reserves to meet its liquidity needs, and they lend out the rest. Today, the reserve requirement on banks is 10% of their total deposits, and they lend out the other 90%. Now, except in times of extreme economic crisis or uncertainty, the probability that a large number or even all of a bank's depositors would come to the bank simultaneously demanding to withdraw their deposits from the bank are extremely small. However, when there is a demand by a large number of depositors to simultaneously withdraw their money, this is known as a run on the bank. A run on the bank creates a situation where the demand by depositors to withdraw their money exceeds the amount of reserves being held by the bank. This means that the bank cannot meet its liquidity needs, which can push a bank to become insolvent. Now, understand that even during normal times, when there is no crisis, it's normal for banks to fall short of their daily liquidity needs, but to a far lesser degree than during a run. To address these common shortfalls, banks borrow money from other banks as short-term or overnight loans. This process allows banks to continue to make loans, maintain reserves, and have sufficient liquidity so the depositors can withdraw their funds on demand. Between 1791 and 1836, Congress had twice attempted to form a viable central bank of the United States. Each attempt failed, with both iterations lasting only 20 years. Then in 1907, the first worldwide financial crisis of the 20th century occurred. It was known as the Panic of 1907. Misappropriation of funds led to several banks becoming insolvent. Banks becoming insolvent led to the New York Stock Exchange, which was heavily vested in bank stocks, to lose 50% of its value in just a few weeks. This stock market crash led to several runs on banks, which intensified the liquidity crisis. As I mentioned a moment ago, Under normal circumstances, when banks don't have enough money to distribute to their depositors, they borrow it from other banks as short-term or overnight loans, usually 24 to 48 hours. The rate banks charge to each other for these overnight loans used to be called the call loan interest rate. On October 22, 1907, the call loan interest rate jumped from 9.5% to 70%, and then just 2 days later to 100% on October 24th. Even at 100% rate of interest, credit was scarce due to, again, lack of liquidity. The events of the Panic of 1907 highlighted the critical need for a central bank to provide liquidity, stabilize the call loan interest rate, regulate banks to prevent fraud, abuse, and misappropriation of funds, and to promote confidence of the American people in the overall banking system to prevent such a crisis from ever happening again. And so, the Federal Reserve System was created in 1913 and has served as the central bank of the United States ever since. In present day, the rate that used to be known as the call loan interest rate, which is the rate charged by banks to each other for short-term or overnight loans, is called the Fed funds rate. But instead of the banks borrowing the money from each other, they satisfy their short-term liquidity needs through the Federal Reserve. The Fed lends money to banks, quote-unquote, overnight to resolve their short-term liquidity issues. The Fed lends this money to the banks at the Fed funds rate. Whatever the Fed sets the Fed funds rate at, a consensus of the major banks in the country adds 3% to it, and that becomes what is commonly known as the prime rate. So if the current Fed funds rate is 5%, then the prime rate would be 8%. If the current Fed funds rate is 4.5%, then the prime rate would be 7.5%, and so on. The prime rate is considered the baseline rate offered by banks to their quote-unquote ideal or model customers. The prime rate is the basis for pretty much all consumer loans, except mortgage loans. Examples of consumer loans are signature loans, car loans, credit cards, home equity loans, and lines of credit, etc. Again, every type of loan except first lien position mortgage loans. A less than ideal customer will receive a higher rate than the prime rate, while a better than ideal customer will receive a rate lower than the prime rate. Understand that a change in the Fed funds rate immediately impacts the prime rate, which means it also immediately impacts rates being offered on all consumer loans, except, again, mortgage loans. This is why the Fed funds rate is the primary tool the Fed uses to manage inflation. If the economy is too stagnant, then the Fed will lower the Fed funds rate, sometimes drastically as during the COVID pandemic, to encourage consumer spending. Conversely, if the economy is too hot, which means demand far exceeds supply, which drives prices rapidly up, then the Fed will increase the Fed funds rate to curtail consumer spending, or demand, and bring the cost of goods and services back down and under control. But while changes to the Fed funds rate will have an immediate impact on consumer loans, it can take a long time, sometimes months or even years, for the impact of the changes to reflect in inflation. This fact is key to understanding what causes mortgage rates to change. So, if the Fed funds rate doesn't immediately impact mortgage rates, what does? Well, to answer that question, we must first discuss where mortgage money comes from. First, let's take a look at the pros and cons of the basic banking model we discussed at the beginning of this video. Namely, you deposit money into a bank account, the bank pays you a little interest, and they use your money to make loans and make a profit. On the pro side, your money is safe, you can potentially earn some interest, your money is easily and quickly accessible. But on the con side, there's no guarantee of return, the interest rate you receive is relatively low, banks can change the rate at any time. This is not really a good mechanism for serious investment growth. For serious growth, you need to invest in something that will pay you a much higher rate of return and has more certainty to it. For example, certificates of deposit, treasury notes, and bonds all have much higher rates of returns compared to typical bank checking and savings accounts. The longer the duration period you commit to, the higher is your rate of return. And the rate of return is guaranteed. Let's use an example of a certificate of deposit, or CD, that you can get at any bank or credit union. Let's say a local bank is offering a 6-month CD at a rate of 5%. This means that the bank will pay you an interest at an annualized rate of 5%, that's the rate of return, to use your money for a period of 6 months, that's the duration. So if you purchase a CD for $1,000, at the end of 6 months, the bank would give you back $1,025. That's your initial principal of $1,000 plus $25 of interest. Depending on how well or how poorly the economy in general is performing, will dictate what rate of return the bank thinks it needs to offer to potential depositors in order to entice them to lend the bank their money. So during a strong economy, meaning inflation is low, a bank can offer a lower rate of return because potential depositors will likely demand a lower rate of return to lend a bank their money. Conversely, in times of higher inflation, the bank will have to offer a higher rate of return to entice people to lend the bank their money by purchasing CDs. So how do certificate of deposits relate to mortgage rates? Well, they don't at all actually, but the principle of how they work is the same. Let's look at the mortgage money market cycle. A lender issues a loan for a home mortgage. Millions, sometimes billions of dollars of mortgage loans are pooled together as mortgage-backed securities. These mortgage-backed securities are sold on the open market as bonds. The bonds are purchased by investors through various financial groups, retirement plans, etc. Funds from the purchase re-enter the system so that more loans can be issued. Just like our certificate of deposit example, mortgage-backed securities have a rate of return and a duration. For example, 3% for 15 years or 4% for 30 years, etc. Also, just like in our CD example, the people who purchase mortgage-backed securities will demand a lower rate of return when the economy is strong versus demanding a higher rate of return when inflation is higher. This is why mortgage rates are so volatile, because bundles of mortgage-backed securities are constantly being created at various rates to meet the rate of return demands of the investors who buy them. And that demand totally depends on inflation. Again, this is why mortgage rates always react much more quickly to news on inflation than anything the Fed does with the Fed funds rate. So does the Fed raising or lowering the Fed funds rate affect mortgage rates? Yes, of course it does. Because what the Fed does with the Fed funds rate affects inflation, and inflation is the primary mover of mortgage rates. But it takes time for the impact of the Fed funds rate changes to trickle through the economy, show in inflation, and ultimately be reflected in mortgage rates. This is why what the Fed does in regard to changing the Fed funds rate has no immediate or direct effect on mortgage rates, and why the Fed funds rate and mortgage rates can actually move in opposite directions in the short term. Case in point, on December 19th, 2024, the Fed lowered the Fed funds rate by 0.25% to 4.5%. But then, after they announced that they were lowering the rate, which was expected, the comments that they made were perceived by the bond market to be inflationary, and the bond market reacted accordingly, and mortgage rates shot up over 0.5% overnight. This is a very important thing to keep in mind. The dates of all the future Fed meetings are known well in advance, and generally, as the meetings draw near, what the Fed intends to do at the next meeting, whether that's to raise, maintain, or lower the Fed funds rate, is also pretty much known and already baked in, so to speak, to mortgage rates. But what is not ever known, and what is most impactful and can have the most dramatic and immediate effect on mortgage rates, are the comments the Fed makes following these meetings. Comments by the Fed that are perceived by the bond market as inflationary can cause mortgage rates to react negatively and spike up, as we saw on December 19th, 2024. Conversely, more neutral comments will cause rates to either be non-reactive or perhaps even have an immediate reactive improvement. So, in sum, the big takeaways from all this are to remember the following. The Fed funds rate is not a consumer lending rate. It is a rate that the Federal Reserve lends money to banks at for 1 or 2 days to meet quote-unquote overnight liquidity needs. Whatever the current Fed funds rate is, to that is added an additional 3% by a coalition of the nation's largest banks. This becomes the new prime rate. The prime rate is the preferred rate given by banks to its ideal or model customers and is the basis of all consumer lending in the United States, except first lien position mortgage loans. The Fed manages inflation by encouraging consumer spending through lowering the Fed funds rate when the economy is stagnant, or discouraging consumer spending by increasing the Fed funds rate when the economy is too hot. It can take a long time for changes in the Fed funds rate to trickle through the economy and have an impact on inflation. Mortgage money comes from the sale of bonds or mortgage-backed securities on the open market. The rate of return demanded by investors, the people or groups who buy mortgage-backed securities, will increase or decrease depending on inflation, which will reflect as a corresponding increase or decrease in mortgage rates. Thus, inflation, not changes in the Fed funds rate, is the primary mover of mortgage interest rates. To really know where mortgage rates are headed, inflation is what you should keep your eye on because inflation is what mortgage rates always follow, without exception. And finally, don't plan any mortgage decisions around what the Federal Reserve may or may not do with the Fed funds rate at their next meeting, because in the short term, they are completely unconnected. If you have any questions, please don't hesitate to call me anytime. I'm always happy to answer any questions. Thank you so much for watching and have a wonderful day.